Welcome back, everyone. The afternoon panel is going to be focused on the global marketplace, and we're going to hear perspectives from investors in Latin America, India, Europe, and other emerging markets. The panelists, the moderator for the panel is going to be David Andelman, who's been an international correspondent for the New York Times, Bloomberg, CBS News, and CNBC, and currently is the editor for the World Policy Journal. So please join me in welcoming the panelists.
Well, that's a bit of my resume. Thank you, and welcome to the panel on the world, the globe today. Quite an agenda we have for 40 minutes or so. It is quite an agenda. The role of the emerging and frontier markets, particularly, say, at least half the world, if not more. We have an eminent panel to take this on. First of all, of course, there's myself. This is our magazine, by the way, World Policy Journal, a great read. You should all read it if you're interested in global affairs. That's the commercial. Now, going down our row here, we have Nicolas Chaput, the CIO at Fixed Income and Money Markets of BNP Paribas Asset Management. If I'm getting any of these wrong, please jump in and correct me instantly, but I'm reading off a little text that I had. Then we have Josh Parrott, who is Director of Public Investments at Hatteras Funds. Then we have Heidi Thompson, Senior Vice President, Portfolio Manager of Daiwa Asset Management, an expert particularly on Latin America and Brazil, as I understand it. Do I have that right? Excellent. And finally, Patrick Morris of HAGIN Investment Management right here on Madison Avenue. So, to kick us off, I'm not going to monopolize this at all, but I wanted to start off with a brief confession on my part. I've had virtually 100% of my retirement funds in emerging and frontier markets for the last 10 years. And boy, am I happy. And these guys are going to tell us why. There have been a few blips on the radar screen, whatever you call them, a couple of years ago. Maybe not quite as happy, but just letting it ride, putting it all on black, as it were. My first question to start us off, though, I guess is somewhat self-serving then, but from your outlook on the role of emerging markets and frontier markets for investors, what is the outlook? Are they really more attractive than developed markets, and where are we going to be going ahead? Who wants to start? Oh, don't all rush forward at once.
All right. I guess I'm on the global panel, I'm the one with the non-U.S. citizen and a French accent, so I'll start. And I think that these days, Eurozone is seen as close to an emerging market again. Anyway, I think that if you look at emerging market opportunities, you need to look at the macro factors, and then as an investor, look at the real life. On the macro side, obviously, I mean, you would be fool not to invest or not to look at emerging markets at the moment. You look at the growth pattern. You look also at the only place where you don't have levered government or indebted government, where you have a very sound banking system, and where you have the only individuals in the world who will be able to lever themselves to push consumption up. So that's the real place where you want to be. On the other hand, you need to get access to these markets. And the real life is not as rosy as it looks, because there are a number of hurdles to be investing in emerging markets. If you take Asia as an example, because it's really on the spot, GDP growth is in some places close to double digit, then you say, well, there is surely good opportunity. Take Indonesia as an example. In one of the largest market in the world, population of 240 million people, GDP in real term as big or bigger than Australia. And then you confront to the real world. The real world is that you want to invest in bonds, and you are looking at a market that is not bigger than $110 billion in outstanding bonds. And you need to look at how am I going to invest if I'm a US dollar holder or euro dollar holder do I have efficient ways, in fact, to invest in local currency market? Is there a market for foreign exchange forward efficient? And then it becomes more complicated, because if you look bluntly at bonds on Indonesia, it's like, I don't know, 2-year paper should be at 6.5%. So you say, well, great. I mean, because I'm in the US or in Europe and I'm being paid 2% or 1%, so I should go there because there's growth, large middle class. But again, it's more difficult than that. So my view is that, yes, there are a lot of opportunities on a macro basis in emerging markets. Now you need to look at the truth about the size of the different and relative markets, the fact that you can access these markets, the liquidity of these relative markets, the legal system. I mean, if you're used to be investing in systems that have seasoned legal governance and bankruptcy laws, then welcome to emerging markets. And I think that's where there is a blend attitude. Of course, it is an interesting market on a global perspective. Now watch the way you're going to invest in it, and watch the liquidity or risk premium that you're being paid, in fact, to invest in these markets.
Well, the risks are interesting. I mean, just today, and Heidi, perhaps you can talk a little bit about this. The Brazil government, for instance, doubled the taxation on foreign investments in debt in Brazil, but left the equity markets alone, which kind of surprised everybody and gave a nice little pop to equities today down in Brazil. But so how about these unknowns in some of these places? These sort of black swans that suddenly arrive out of the horizon, right?
Well, I mean, I think these are difficult times right now. Every country is acting in its own best interests. This was not a surprise that the government raised the IOF tax on fixed income yesterday. We've known this was coming for 2 weeks. It was a little bit of a surprise because the presidential election in Brazil was not decided in the first round on Sunday. So, we thought there might be a delay, but there was not. And just the question now is, how is that going to be implemented? Because 1 year ago, Brazil implemented a 2% IOF tax on all foreign investments in Brazil at the FX level. So whenever you buy reais as a foreign investor, you pay 2%, whether you're buying equity or debt or whatever. And so then what happened? People try to avoid that. What did they do? Well, foreign investors bought ADRs, converted them back into the local shares, through the custodian. That costs you 35 basis points, but it's a lot less than 200 basis points. So we created a market for, getting around this. And then, the finance ministry acted and, closed the loophole there and charged a 1.5% tax on that kind of transaction. So that ended. So now, we've got, an extra 2% charge on fixed income investors. What are they going to do? I mean, we may see, the hedge funds coming in and buying equities, and then, selling the stocks and buying bonds. We don't know how it's going to be implemented, but this is not a surprise. But if I could, I'd like to make, sort of the broad brush case for Latin America right now, because I think more than other emerging markets, it's a region that suffers from a lot of stigmas. We had the debt crisis of the 80s. The reputation is that Latin American countries are over-indebted, that they don't have good fundamental, fiscal regimes, and that there's a bunch of banana republic dictators down there running everything, and that's just really not the case. We've got a very strong macro case in Latin America, like in other emerging markets, based above all on strong macro fundamentals. First, economic growth. Here we are in the U.S. hoping we can truck along at 2%. The region overall, Latin America, is going to grow 6% this year and 4% next year. Okay, Brazil, 8%. Chile, over 5%. There's real solid growth. The fiscal houses are in order. Brazil's debt to GDP ratio is just about 40%. What is ours? I think it's over 100, Brazil's got $275 billion in foreign currency reserves right now. What have we got? We've got 125. So I mean, I think there's a stigma from the past, from the fiscal mismanagement, from the hyperinflation that really, is outdated. And I would just like to call your attention to the fact that the MB, well-known Emerging Markets Bond Index, that is now BBB. That is investment grade as of last spring with the upgrade of Turkey. And the local currency MB index is A-rated. Where are U.S. corporate bonds? They're BBB, they're A. We're in the same ballpark.
Josh, do you want to make a particular case for a particular region of the world, or debt versus
just
equities?
From a 30,000-foot view, I mean, we look at the U.S. is primarily driven by, I would say, more sort of value opportunities. But as you look to emerging markets, you can see them as more sort of equipped to provide growth prospects for allocators. And I think if you look specifically at the way we approach it, we take sort of a picks and shovel approach to investing in Asia, trying to find ways to exploit domestic consumption. I think a few years ago it would have been more oriented towards how to sort of capitalize on exports, but that too has shifted over the last year or two to shift our own portfolio allocations.
Patrick, what's your favorite region of the world, or do you a particular asset class you like?
Well, I'd actually say I'd make the case for India, which is a rapidly growing country. It's got a young workforce. It's going to stay young for a long time. It should surpass China in growth rates by about 2030, population about 2050. There are 45 million. I mean, it's hard to get these numbers. I don't know where they really consolidate some of these things, but it's estimated there's 45 million entrepreneurs in India opening businesses every day. One of the issues, though, and it was touched on earlier, getting access. I mean, if you're going to invest in a place like India or Brazil or frontier markets, I mean, these India, Brazil, China, Russia, these are developing. These are large economies. These are, a lot of people. And, they've sort of been on the radar for a long time. But it's still not that easy to make direct investments into these countries, to get access to small and mid-cap companies. To our way of thinking about the world, we're focusing on India in a combination of public and private, using mid-cap and small-cap public equities, real estate, direct investment into natural resources plays. But it takes licenses, and it took 3 to 4 years just to get the licenses together to do that. And if you're going to move into frontier markets, I think it's extraordinarily different story.
Some frontier markets have done remarkably well, like Vietnam, for instance. The stock market there did remarkably well for quite a long period of time, right?
It's not terribly liquid, though. It's hard to get large sums of money into those markets, and when you take it out, there is going to be a pretty heavy footprint when you exit. I think a lot of the foreign investments are still very susceptible to flows from foreign investors, foreign institutional investors, and that's something that will be sort of, that'll continue. I would finish just by saying that it's also important to differentiate between developing companies, growth companies in developing and frontier markets versus large multinationals. India, for example, I mean, Tata Industries, it's a magnificent company. It's a great global company. But it's going to have to slow down on its growth rate because it is getting so large. You can only grow at a high rate for a certain period of time. So I would say you have to differentiate what you're investing in all of these places. But India is my favorite, and well, that's why we invest there, I guess.